$1,487, both showing modest gains on the session. Over the last 6 to 12 hours, the dominant market story was the resolution of the United States government shutdown. President Trump signed legislation to reopen federal operations, ending the 43-day closure. Markets interpreted that development in two linked ways. First, the end of the shutdown removes one headwind to economic data flow. Jobs and inflation reports that had been delayed will now be released. Second, analysts noted that reopening will raise near-term US borrowing and therefore federal debt levels, which changes the outlook for the Treasury market and kept traders focused on possible monetary policy responses. Precious metals reacted to those developments through the classic channels. Lower expected short-term real rates and the prospect of easier policy increased the appeal of non-yielding assets such as gold. At the same time, the reported resolution increased the chances that missing economic data will show weaker growth, reinforcing expectations of further Federal Reserve rate cuts. The markets had already priced in a high probability of a 0.25 percentage point cut at the December meeting, according to recent surveys cited by Reuters. That combination, weaker growth data, lower real yields, and softer US dollar momentum, supported bullion in the early session. On the fixed income side, the benchmark 10-year US Treasury yield moved lower in recent trading. A fall in the 10-year yield reduces the opportunity cost of holding gold, which helped bullions advance in the opening hours. Reuters snapshot reporting this week showed 10-year yields eased by a few basis points as traders digested the end of the shutdown and the prospect of resumed data releases. Lower yields also tend to weaken the dollar, which mechanically lifts dollar-priced commodity prices such as gold and silver. Currency moves were also a further factor. The US dollar has been on the back foot this month as markets increasingly priced Fed easing, and the dollar's recent softness lifted metal prices dominated in dollars. Currency crosses matter for physical demand. A weaker dollar makes bullion less expensive for buyers using other currencies, notably in Asia, where physical demand remains significant. Traders and analysts have repeatedly pointed to the dollar's behavior this year as a key driver of precious metals rally. Silver's move deserves more of a separate analysis. Silver rose more strongly than gold in the earlier session, gaining on reports that physical demand remains robust. Traders noticed strong retail and industrial buying, especially in the face of recent price momentum that has pushed silver close to its record highs. Silver's dual role as a precious metal and an industrial metal makes it sensitive to both safe haven flows and industrial consumption. The morning's price moves emphasize the investment side. Reuters quoted market participants highlighting robust physical demand and ETF inflows as supporting factors. Platinum and palladium were more muted but still edged higher. Platinum showed a small uptick in early trade, while palladium advanced a little more strongly as another leg of the metals complex that can benefit from tighter supply dynamics. The rise in platinum and palladium were fractional compared with gold and silver, but they were consistent with broad-based buying across the complex. Reuters market coverage captured those intraday movements. Gold has had an extraordinary year. It is substantially higher than a year ago, following a campaign of central bank buying, renewed investor interest in defense assets, and periodic geopolitical shocks. The World Gold Council's demand analysis earlier in the quarter documented record investment into gold, ETFs, and bars, which helped to lift prices over the year. The WGC noted that investment demand surged in Q3 as central banks continued to accumulate gold and retail investors increased allocations. That backdrop explains why a day-to-day political development, such as the US shutdown, can still spark meaningful price moves. The market is already positioned for safe haven and inflation hedging purchases. Looking at supply and miner activity, there were no material miner press releases today affecting spot levels. Quarterly production updates from major producers have influenced prices at times this year, but in the last 6 to 12 hours, there were no new announcements from major producers that altered market sentiment materially. For the record, major producers such as Fresnillo and Newmont have been in the news over the course of the year with quarterly figures and strategic moves, and those ongoing developments remain relevant to the medium-term supply picture. Where there are metal corporate developments, they will be reported promptly too. Turning back to the relevant macro drivers in a little more detail, first, central bank policy expectations. Market surveys and pricing shows that investors increasingly expect more easing from the Federal Reserve than had been anticipated earlier in the year. A Reuters poll this month found a dominant view that the Fed will cut rates next month, a view that lifts non-yielding assets. The European Central Bank and the Bank of England both remain in focus for investors assessing global yield differentials. Those differentials and changes to them feed into metal prices through the exchange rate and yield channels. Second, data flow. The end of the shutdown clears the way for the release of delayed US economic indicators. If those indicators confirm softening in the labor market or lower inflation readings, markets will likely increase the probability attached to Fed rate cuts, which is supportive for bullion. If the data comes in stronger than expected, the reaction could be the opposite. For now, the market reaction this morning reflects cautious pricing that favors the cut scenario. Reuters coverage described both the expected data return and the market's current interpretation. Third, ETF flows and physical buying. Exchange-traded funds remain an important source of demand. The World Gold Council and industry trackers have reported significant inflows into physically backed gold ETFs over the recent quarters. Those flows have been large enough to be price supportive, and the morning session's moves were consistent with further inflows as investors sought to front-run anticipated monetary easing. For silver, physical retail buying and industrial demand proved additional impetus. Fourth, geopolitics and supply uncertainty. Geopolitical tensions and trade uncertainties earlier in the year contributed to elevated safe haven demand. Even where acute events have eased, the structural pattern of higher demand for safe assets remains relevant. That helps explain why gold's reaction to the end of the shutdown was a positive one. Investors prefer to maintain allocations to insurance assets while policy uncertainty and fiscal pressures persist. Let's summarize the technical picture for each metal. So, gold in the last session, gold rose to the highs of the recent 3-week range. Spot gold was reported around $4,227 per ounce in earlier London trading, up around 0.7% on the session. The immediate drivers were weaker real yields and a softer dollar after the end of the US shutdown, plus persistent ETF demand. Over the past 12 months, the metal has posted very strong gains driven by central bank buying and retail and institutional investment, a pattern documented by the World Gold Council and market commentators. Silver outperformed gold on the session with an advance into the mid-50s% ounce. Reports highlighted robust physical demand and ETF flows as key supports. Silver's industrial characteristics mean its outlook also links to manufacturing data and industrial sentiment, which remain watchpoints as delayed US data flows resume. Kitco and Reuters coverage both noted silver's stronger near-term momentum. Platinum was slightly firmer, trading nearer $1,616 an ounce. Its move was modest and led by general risk appetite across the metals complex. On a 12-month view, platinum has lagged gold in percentage terms, but remains sensitive to automotive demand and supply dynamics in South Africa. Analysis continued to monitor PGM inventories and industrial end-use trends. Palladium. Palladium ticked higher as well to roughly $1,488 an ounce. Palladium's price action is influenced by auto catalyst demand and the palladium-platinum substitution effect in the vehicle sector. Supply tightness in previous years had been supportive. Recent moves suggested traders are pricing shorter-term momentum as market players weigh industrial demand against elevated precious metals allocations. Across 2025, metals complex has seen extraordinary volatility and an overall upward trend for gold and